Ladies and gentlemen, good day and welcome to Q4 FY22 earnings conference call of Max Healthcare. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us on Max Healthcare's Q4 and FY22 earnings conference call. We have with us Mr. Abhay Soi, Chairman and Managing Director, and Mr. Yogesh Sareen, Senior Director and Chief Financial Officer of the company. We will begin the call with opening remarks from the management, following which we have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Abhay to make his opening remarks.
Good afternoon, everyone, or good evening. A very warm welcome to all joining us for the fourth quarter earnings of financial year 2022. Let me provide key highlights of the past quarter before opening up the forum for question and answers. Q4 performance was in line with our expectations. You would recall in our previous quarter's earnings call, we had highlighted the impact of Omicron wave on bed occupancies in the first half of the fourth quarter FY22. Subsequently, the occupancies bounced back sharply. Moreover, aided by resumption of international travel, international medical tourism recovered back to 90% of pre-COVID levels in March 2022. The initial drop in occupancies was mainly due to the Omicron wave, this time characterized by high rate of infections but low hospitalizations. Nevertheless, non-COVID elective work was impacted, as has been the case in the past. COVID admissions remained poor this time. The strong recovery in the second half mitigated the initial dip in occupancies to some extent, and thus the average occupancy for the quarter stood at 68% as against 60% in January. Fourth quarter EBITDA was rupees 304 crores with operating EBITDA margins of around 25%. This is after one-time cost of rupees 7 crores incurred in relation to the two inorganic transactions announced during the quarter. The highlights for the fourth quarter performance were network gross revenue of 1,298 crores, a growth of 12% year-on-year, but degrowth of 7% quarter-on-quarter. Due to widespread Omicron infections, a number of doctors were infected, leading to disruption of work in some of the specialties in the first half of the quarter. The digital channel contributed 13% of the revenue. Network operating EBITDA stood at rupees 304 crores in Q4 of FY22, demonstrating a growth of 16% year-on-year and degrowth of 16% quarter-on-quarter. The EBITDA margin was 24.8%, leading to a profit after tax of 172 crores. And like I mentioned, this included a 7 crore one-time, transaction cost for the two inorganic transactions that we did. Absolute number of beds used for the institutional patients were lower than quarter 3. However, due to overall drop in occupancies and occupied beds, relative share of such patients shows an increase of 31% to 33%. The ARPOB for this quarter was 63,500, implying a growth of 13% year-on-year and 4% quarter-on-quarter. This was assisted by the growth in international revenue, as I mentioned. Cash generated from operations after interest, tax, and replacement capex was 179 crores during the fourth quarter. Rupees 328 crores was invested in growth initiative, which includes acquisition of stake in Equa Healthcare for 400-bedded hospital in East Delhi. Operations and management agreement for the under construction 300-bedded hospital in Dwarka, purchase of transferable development rights for Gurgaon lands, and other brownfield expansions at Shalimar Bagh, Saket, and Nanavati, Mumbai. Further, we onboarded 28 new senior clinicians in oncology, liver transplant, neuro, and cardiac surgery. We also served 34,000 indigent patients in IPDs and OPDs free of charge. The notional value of this treatment was rupees 44 crores. Coming to the strategic business units, Max Lab, which is a non-captive pathology business vertical, added 60 channel partners during the fourth quarter FY22, taking the overall active clients to 760 spread across 25 cities now. Revenue grew by 40% year-on-year and 11% quarter-on-quarter. We continue to invest in this business and have augmented the operations, marketing, and IT teams and increased our commitment to brand building. Then comes Max at Home, our home healthcare vertical. We reported a gross revenue of rupees 28 crores, similar to the third quarter levels, and representing a growth of 21% year-on-year. We have added around 70 people in the team during this quarter. Coming to the overall fiscal FY22, it has been an eventful year, to say the least, where despite numerous challenges, there was a marked improvement in the performance. We closed FY22 EBITDA at 1,390 crores, which is more than double of the rupees 636 crores we achieved in the previous year. In addition, as part of our inorganic growth strategy, we have announced 4 transactions, including purchase of 2 prime land parcels in Gurugram. These will have a combined potential to add 2,200 beds in the coming years, in addition to the ongoing brownfield expansions. The key highlights for the year have been network gross revenue stood at 5,509 crores as compared to 3,881 crores in FY21, a growth of 42% year-on-year. Network operating EBITDA stood at 1,390 crores as compared to 636 crores in FY21, a growth of 118% year-on-year. The EBITDA margin was 26.6% and the PAT was rupees 836 crores. In line with our strategy to improve the payer mix in FY22, the bed share of institutional patients has been reduced to 31% versus 34% in the previous year, FY21, by way of disempanelment of few institutional accounts at some of our network facilities. This process could have been accelerated if it wasn't for intervening periods of low occupancy during COVID to non-COVID switchovers. ARPOB improved by 17% year-on-year to rupees 58,500 in FY22, and EBITDA per bed improved by 78% year-on-year to rupees 53.9 lakhs during the year, in spite of lower earnings from COVID beds. Cash generated from operations after interest, tax, and replacement capex was 770 crores. The routine capex spent during the year was higher due to catch-up for FY21 replacements. The investment of rupees 671 crores in the inorganic growth initiatives and brownfield expansions was totally funded by internal accruals. Overall, net debt, including put option liability of rupees 139 crores, has come down by rupees 103 crores to rupees 441 crores as on March 31, 2022. To recall, the inorganic growth initiatives announced during the year were: 1. Acquisition of exclusive rights to aid development and provide medical services to an upcoming 500-bed hospital in Saket. 2. Acquisition of 2 land parcels in Gurugram at measuring 11 acres with the capacity to add over 1,000 beds. 3. Asset-light expansion through a 300-bed under-construction hospital in Dwarka, Delhi. And 4. Acquisition of stake in Eqova Healthcare, having the potential to add 400 beds in East Delhi. These transactions, like I mentioned earlier, have a potential to add 2,200 beds to our network. Of these, we plan to operationalize 1,500 within the next 4 to 5 years. In addition, we have 4 ongoing projects for brownfield expansions, which put together will add 1,300 beds over the same period. Hence, collectively, we will be adding over 2,800 beds in the next 5 years, 4 to 5 years, with expected capital expenditure of 3,700 crores that is intended to be funded through internal accruals alone. During the year, we also served 126,000 indigent patients in IPDs and OPDs free of charge. The notional value of this treatment overall was rupees 160 crores. This year, Max Lab added 370 new channel partners, taking the active clients to 760, spread across 25 cities. The revenue grew from 68 crores in FY21 to rupees 104 crores in FY22, resulting in a 53% growth year on year. But more importantly, non-COVID revenue grew by 85% in FY22 as compared to FY21. Max at Home reported gross revenue of 112 crores, representing a growth of 60% year on year. In addition, this team played a stellar role in COVID vaccinations during the year and took a lot of the load of the hospitals. Going forward, we see the following additional levers helping us in improving our performance in short to medium term. 1. International medical tourism growth from both existing and new geographies. 2. Improvement in payer mix. 3. Impact of senior clinicians onboarded and continued strengthening of medical programs. 4. Inorganic expansion in both hospital and diagnostic space. Finally, we are also working on the digital front, which will not only help us engage with more patients and widen our reach, but also serve our customers better and provide improved experience. On this note, I would like to open up the forum for question and answers. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, you may press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nikhil Mathur from HDFC Mutual Fund. Go ahead.
Hi, good evening. I hope I'm audible.
Yes.
Yeah, sure.
Hi, Nikhil.
So my first question is on EBITDA per bed that the company has recorded in 4Q. Now, ARPOB has improved sequentially. That would have added on to EBITDA per bed. But obviously, there's operating deleverage because of occupancy going down substantially. Assuming, let's say, in 1H FY23, the mix remains stable, and based on the April occupancy trends that have been shown in the investor presentation, would it be safe to assume that the annualized EBITDA per bed in 1H FY23 is looking much better than what you did in your best ever quarter in 3Q FY22? This is taking into account any recent inflationary trends that you might have been witnessing, which were not present, let's say, a few months back.
So I think two things. I think immediately we have not had any significant inflationary pushes that were unanticipated at present, which may not be the case going forward, but it's hard to call right now. Having said that, you also know that, we don't give forward-looking statements. But if you were to sort of look at what the trend has been, and what the occupancies are, quarter 4 normally is a strong quarter. But the first half of the quarter was, had pulled down the average, and the second half of the quarter was significantly better. At least on the, the second half, if that sort of continues into the first, and, from industry standpoint, there's no reason for that not to happen. I think things should continue in the manner that they are. But as far as the EBITDA per bed is concerned, if I look at last quarter 3 was 60 lakhs. This quarter it's about 56 lakhs. But if I was to sort of normalize for that one-time expenditure on the 2 transactions, which is EBITDA, we will come to about closer to 58 lakhs. So I think there's a reduction of about 2 lakhs in that, but some of it can also be, or a lot of it can be attributed to the lower OPDs, which we had in the first half of the quarter.
Oh, got it. Also, if I look at the direct cost as a percentage of sales, they seem to have gone up quarter on quarter by around 140 basis points. I mean, mix would have been better, I believe, with more of international patients coming in. So any particular reasons why the direct cost would have gone up by 140 basis points on 2 basis?
So, Nikhil, obviously there are some beds being used for COVID patients, right? So there's an average of 7%, beds are used for COVID patients. So that COVID ARPOB is lower, that, and also the consumption of material is high. Also, when the COVID comes in, there's a lot of PPEs that we have to use. So then the store consumption goes up. Also, relatively, I think Abhay mentioned this already in his speech that there is some because of the fact that the overall occupancy came down, the relative ratio of institutional business went up, right? And institutional business, is a lower margin business for us, right? So that obviously comes and kind of plays into the direct cost. Also, there's a fixed component of clinician cost, right? And that doesn't come down if there's a 1 month aberration here there. So that all leads to a higher direct cost because of the fact that we don't do much on that side.
No, but I think what you need to also focus on is EBITDA per bed, okay? Because what happens is the more medical programs that you do, okay, versus surgicals, medical programs have lower direct cost, whilst surgical programs will have higher typically, okay? But that's what you want to drive towards, the surgical, because eventually you also have a higher sort of flow through in terms of absolute numbers.
Okay, sure. I just wanted to recheck on Nanavati here. So the bed addition of 330 beds that has to be done, and 160 beds have to be demolished to achieve that. So basically, the 288 beds which are there currently operationalized, that number will go down to 120 odd, and then obviously plus 320 or 330 addition. That I'm just rechecking. Sorry, I might have forgotten from last earnings call.
So let me sequentially take you through it. What we are doing it in 2 phases. When we do phase 1, we add 350 beds. Okay, we don't demolish anything. I think the exact numbers we wish to provide, but okay, we are 329. Okay, we are not demolishing anything at that stage. When I do phase 2, then I have to demolish a part of phase 1. I have to demolish a part of the original structure. That's when I go down, okay, but in a year and a half I add. So I'm adding 650 and I'm demolishing about 150 on an overall basis, right? So you're going to end up with, I guess 650 plus 340 minus 150 or whatever. Eventually.
Okay, so demolishing basically.
So exactly. So it's not as if you reduce the number of beds and then you're doing phase 1 and phase 2. Okay. So first the phase 1 comes up, then if we are doing phase 2, which we are doing, okay, but let's say for some reason you decide not to do phase 2, right? Then you don't demolish phase 1. You don't demolish the original structure.
Okay.
And Nikhil, after both the phase completion, we will be having 760 beds in Nanavati after completion of both the phases.
Okay.
That's census beds. That's census beds, not total beds.
Yeah.
Right.
Do the IPD beds.
Sure. Okay. And another question on Nanavati. I don't know if you would be comfortable sharing this or not. But have all the cost restructuring initiatives taken place in Nanavati, and EBITDA margins, whatever you wanted to achieve, whether at par with corporate or a few percentage points lower than the corporate, has that been achieved, or it's still an ongoing process and a lot more can be achieved in 23 and 24?
So I think there's only one line item, which is the personnel item. The VRS you have to do in phases. We brought down the cost of employees over there, but it's still closer to the 30% mark rather than the 20 to 23%. So there's definitely 6% elbow room over there. Now, we are hoping to bring it down over the course of the year to that. But like I mentioned earlier, in any case, it gets normalized when your phase 1 comes, because then your people get spread over a larger sort of, you still need the people, you'll be employing them.
Sorry, did I hear it correctly that you're targeting 30% mark and you are 6 percentage point lower than?
No. So where it is off Nanavati it's close. The personnel cost is close to a 30% number.
Okay.
Rather than what we have everywhere else because it's, you have to do VRS. These are old inherited employees, unionized employees. So you have to do VRS over there. We did the first round of VRS and the cost had come down because of this. Now we will be doing subsequent rounds.
Okay. Thank you so much. I'll get back in the queue.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Damayanti Kirai from HSBC. Please go ahead.
Hi, thank you for the opportunity. I just want to understand your thoughts on increased competition in diagnostic space, entry of some large players having strong financial muscles. So, in such scenario, how should we look at prospects for Max Lab?
So I think first and foremost, if you actually see the results of Max Lab versus a lot of the other standalone laboratories, etc., okay, we've had a healthier growth on the non-COVID businesses, relatively speaking. Obviously, it's on a much, much smaller base. I keep relating to that ad, which used to be the tires we race are the tires you buy, which used to be a MRF tires ad. It's pretty much the same with Max Lab as well. All of what Max does, okay, is predicated on the efficacy and the efficiency of our laboratories within the. That's what all our senior clinicians and everyone sort of rest their entire practice on, right? So it's very, very high-end sort of work. The efficacy, the efficiencies of that are and eventually remember one thing: the arbitrator of a result, okay, is a doctor. Your doctor is going to see a report, he's going to see a biopsy and say, look, so-and-so company, this thing, etc., it's showing positive. Do you want to get a second opinion? Because you can't necessarily rely on the new entrants, etc. Okay, you can't discount or discard a Max Lab report. It's come from hospital, right? So that is our modus operandi. That's our reason to survive in this business compared to everybody else. Therefore, whilst you're going to have competition and so on and so forth, the fact is it's not like pharma. You're not going to get yourself pricked twice. You're only going to do it once, even if the first one is free. So all of these players coming and using discounting tactics, etc., works for some, perhaps, lower end tests, etc. But I don't think it kind of applies to hospitals and hospital labs. Pricing will, in the short term, of course, have some sort of will have a pressure. But people who go to hospitals and hospitals still have a USP. Okay, as far as this is concerned.
Yes,
so I see that as a moat around our business.
Right. Sorry. Right. So I completely agree with like brand equity associated with a brand like Max. But nonetheless, say if a new entrant is coming and offering this 100 rupee test, so definitely we'll be seeing some shift in volume. Okay, maybe it's lower end, but it's part of volume can shift in there, right? So I just wanted to understand that part, how you think there.
So again, like I said, the arbitrator of the test is a doctor. Okay, eventually he has to decide. If somebody does you a 100 rupee test, you take it to a doctor and the doctor looks at it and says, I'm not sure when to get a second opinion because this does not relate to your previous test, right? Even if the first test was 100 rupees or free for that matter, okay, you don't want to get yourself pricked the second time. This is invasive, right? Somebody is doing a blood test. It's not like it's not like a medicine. Okay. Having said that, with somebody else is purely playing on price because the same brand you're giving at a cheaper price. But having said that, I do completely agree with you. Okay, that with all of these players coming, you will have a lot of volume moving towards that as well. But do remember, 70% okay of the business is sort of disorganized. 30% of it is amongst some of the larger players. We still continue to be a very solid but small player. Okay, you're going to see a lot of movement happening with the big players in my mind. Okay, because I think the larger players are something to worry about with all this discounting. But this discounting is, please understand, this discounting is the whole strategy of discounting. If you do it for a few years, you take market share, then you raise prices, right? We see it in telecom, we see it in others. I'm not getting impacted right now. Perhaps we will to some degree, but not too much. But we will stand the course. We'll stay the course because, look, eventually people will come for higher end tests and so on and so forth. Even that market is increasing, and they will keep coming to Max Lab. And by the end of the day, proof of the pudding is eating, right? And you see our numbers and see everybody else's. Again, like I said, it's a very small base.
Okay. Okay, that's helpful, I think, to understand the scenario. My second question is on ARPOB. So we ended fourth quarter at 63,500. So that's around 12% growth on previous year's base. So again, I think if you can just try to make us understand like how far we can go in terms of ARPOB growth and what will be the key drivers from here on, because in this fiscal we definitely had some benefit from COVID related test, vaccination, etc. So excluding all these, what will be the key drivers for ARPOB going forward?
No, so if you don't look at it on an annualized basis, okay, so like this quarter, we had no vaccinations and really hardly any COVID-related tests. Similarly, in the previous quarter as well. So I don't think that argument holds that the higher COVID sort of thing. And every quarter that you've seen, we have shown ARPOBs and we've shown EBITDA per bed minus the COVID vaccination and COVID-related tests in each one of our quarterly results. So the ARPOBs that we've been speaking about do not include vaccination. Confirm that, Yogesh?
That's right. So it actually says it doesn't have anything, any vaccination, does not have any Max Lab revenue into it.
That's right. So it doesn't have these two things. So like I said, that argument doesn't hold. That's one. And I think, again, I'll just go back to what I've been sort of saying and underline the same fact. The two drivers of ARPOB, okay, or the three drivers, one will be a clinical mix, which is incremental, it's not exponential. I see a major push coming from their mix change because moving away from institutional business that you've seen. I called it even a year ago, and what you're seeing right now is the results of that. And the third is, the international business coming back. Again, it is something that I said that by the end of the financial year, we should be getting close to 100% or we'll be 100%. We had the Omicron wave, so that got delayed a little bit. We got back to 90% by March. But in my mind, you will get to that number very soon, and you probably see that if you haven't already done that. So all of that, international business is high ARPOB business. The minute you're moving institutional beds down and replacing it with CTI, that gives me 40-45% more revenue. That means my ARPOB of those beds is 45% higher. And it's a mathematical exercise.
Okay.
So I won't get worried about, or concerned about seeing higher ARPOB over here. I mean, international ARPOB is significantly higher than this. I mean, theoretically speaking, if you have a hospital only does international business, you'll have ARPOBs upwards of 90,000, 1 lakh.
Okay, I'll take it. Thanks, Abhay. I'll get back in the queue.
Thank you.
Thank you. The next question is from the line of Praveen Sahai from Edelweiss Wealth. Please go ahead. Praveen Sahai from Edelweiss Wealth, your line has been unmuted. Please go ahead with your question.
Yeah, sorry. I was on mute. Thank you for taking my question. So just to, question on the last participant's question, is there a further room for improvement in clinical mix? Because in the last couple of quarters, we had observed that the clinical mix has improved significantly after a COVID. So is there a further room for improvement there as well?
No, so look, I think, one is movement from COVID to non-COVID, right? I think, in movement from COVID to non-COVID, there is a step change in clinical mix because the minute you're moving from medical programs which are capped in pricing, okay, to non-medical or surgical programs which are not capped, okay, they have higher ARPOBs, they have higher EBITDA per beds and so on and so forth. Having said that, the two big, like I said, on the clinical side, okay, if I look at business as usual, okay, so let's say what I'm doing this month or what I was doing, whatever, when there is no COVID, on normal high occupancy, when I'm operating at 73-74% occupancy levels, the sort of ARPOBs that I'm doing, what is going to drive that? Okay, I'm talking about times when there isn't much COVID happening or any COVID happening. In those situations, our clinical mix, okay, is already superior. We already do a lot more of that. So I'm not saying there won't be increase, there will be, but it will be incremental increase. And then again, relatively speaking, ARPOB is driven by three things and three things alone. Okay, it's driven by your pricing. Okay, which every year you're going to have that 2-3% impact of pricing on your overall revenue. Okay, it's impacted by your payer mix, where we are going to see a step change, or there's an opportunity for a step change simply because you got 30-odd% beds which are still doing business at 45% lower rates or 40% lower rates. And the third is the clinical mix. The clinical mix is already superior. It's not as if we're adding clinicians. You'll see further increase over here, but you're not going to see a step change because of which. You see it because of other two things. So I hope that answers the question.
We lost his line, so while we wait for him to join back the queue, we'll take the next question. Before that, we would like to remind our participants, ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Hemal Shah from NR Shah Associates. Please go ahead.
Yeah. So my question is, running a hospital involves very high management of labor and is extremely service-oriented. Now, we have grown very nicely in past and also planning to grow very nicely in future. Does it act as a constant as we go and our size increases?
Sorry, does it act as a constant? Is that what you asked?
Yeah, because now, now we will be say close to 5,000-6,000 beds in next 5 years. But once that is crossed, will it act, because extreme labor management and service oriented is our industry. So does it put a constant beyond which it will act as a constant?
No, so look, I think there are two things. Okay, one is you're absolutely right. It is the service industry is extremely people oriented. We have over 25,000 people who work for us at Max Healthcare. But do keep in mind that we have a huge amount of unemployment in the country. We have a massive demographic dividend. Okay, we have such a large population below the age of 25 who are looking for jobs. So although overseas you're seeing this right now, that you're seeing a shortage of trained manpower. But we are the largest exporters and providers of, medical technicians, doctors, nurses to the world. And do keep in mind, okay, all of it sort of reflects in the price, doesn't it? I mean, today, a price of the cost of a nurse or even a resident doctor in India, okay, about 45,000 rupees a month. I mean, compared to any of their Western counterparts, I mean, it's nothing.
No. So my question is more from our management bandwidth to manage it.
No, we have no issues on the management bandwidth. A lot of expansion is happening through brownfield. So brownfield, what happens in the same hospital that you sort of expand. So I mean, if you look at the Bombay example, okay, it's like Hinduja puts up another wing. You're not going to put up new management. You need more sort of people at the bottom end. Having said that, okay, you are going to increase teams such as projects, digital, and so on and so forth, because these are some to sort of focus on growth opportunities.
All right.
But do keep in mind also, Max.
Yeah.
Also, look, I think it's not as if what you're saying is not valid. It is a valid question. Okay, that's a challenge that all top management across all successful organizations face today. Okay, how to sort of reward, retain, their top managers, senior managers, and attract new talent from the market. So I mean, that's a constant.
Right. And so my the second question is the color on the scope. If you can give me some color on the scope of inorganic growth opportunities available.
Inorganic growth opportunities available.
Yeah.
I think there are plenty of inorganic growth opportunities available because there are lots of PE-owned hospital chains up for sale. There are lots of standalone ones up for sale. So I can't give you color beyond that, but I think there's quite a bit available. It's not as if it's not. You're seeing, some sensibilities around valuations, those hectic periods of, so it's getting back to serious business, right? I think all of the stuff that we were seeing in the equity markets and in transaction values, etc., there's seems to be some semblance at least right now.
Okay. Thank you, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Praveen Sahai from Edelweiss Wealth. Please go ahead.
So my next question is, as you had mentioned in the presentation that the central government health services has some delay in the payment. So can you give some detail from which facility, which location you got a impact of that, and how much is outstanding is that?
So I think Yogesh can give you the exact outstanding, but typically what happens is that the government has if I look at previous history of the last 20 years, they have a habit of sort of the intermittent delays. And you see bunching up of payments, and suddenly for months you don't get payments, then suddenly you get into for this thing, etc. So they kind of accumulate and they get released. That's one. Having said that, the central government, this is the payment is made through a portal, or the system works through a central government health scheme, which is moving to the NHA now, which is moving to a different system. Okay, so the delay which is happening right now is because of that they're moving to an NHA. Okay, whilst so it's literally a handover happening, and it's not just us. I think everybody in the industry, everybody sort of impacted. We perhaps a little more so because we do more, like you've seen, we do a higher proportion of institutional business at our hospitals. Yogesh?
Yeah, so our outstanding is, as at end of April, it was around 270 crores of outstanding. So we've been talking to NHA for quite some time. We've been told every month that, they'll be paying us some money, and we also had a meeting with health minister, etc. But then eventually, we have taken a call to stop the OPD business. That means we're not doing the OPD at the CGHS rate. You know that the rate is 156 rupees per consult. So we stopped that, and that's the news item that you would have seen in the front page, in the Times of India. But I think we're getting a signal that they are now getting their house in order, and we should be getting some payments in the course of next 2 weeks.
Okay.
So frankly, I'm not perturbed about this.
Okay, great.
When it accumulates, we push. We also come up with media stories and write letters and so on and so forth. But that's all part of the game with the government.
Okay, that's helpful, sir. And the second question related to the outpatient. So I can understand for this quarter because of Omicron. But in the last, continuously from second quarter, third quarter, there is a down, and then from third to fourth quarter, there is a down. So, do you see, this trend to change, and you are seeing this currently because April, May already is done?
No, I think we only see it down. OPD business only lower in COVID quarters or COVID months. Otherwise, you see a sharp bounce back in non-COVID months.
So let me state this. So I think basically on this OPD footfalls, I think typically in quarter 3 is generally a soft quarter because of this festival season, etc. And also in quarter 3, as we would have mentioned this earlier also, that we have disempaneled ourselves for some of these state schemes where it was high OPD footfalls but low IPDs, right? So for example, DGHS, etc. We had disempaneled ourselves. So there was I would say degrowth in quarter 3 versus quarter 2 in terms of the OPD footfalls, and that was by design, right? So it wasn't something that we not anticipated. So it's because of the fact that we wanted to bring down the institutional business. So we picked up those institutions where it was high OPD and low IPD, because we were also facing a lot of constraints on the OPD side, right? So I would say in quarter, as we see, April onwards, the numbers are getting normalized.
Right, got it. And on the occupancy side, can you give any color on the normal high level of occupancy you can reach to a hospital-wide? Like how much of the maximum any hospital can go up to in the occupancy?
You can go to 77, 78% on a sustainable basis. We've done 81%, 82%. Some of our hospitals even consistently for years have been doing at 80% plus. But you do it on a sustainable basis at that level. It does compromise. I won't say outcomes, but definitely your discharge time, your admission time, and so on and so forth. So patient services. So 77, 78% is what I would put it to.
Right. So
at the network level.
Yeah. Lastly, on the pricing, sir, is there any increase in the pricing happened in the past quarter, or you are expecting increase in the prices in the coming quarters?
So yes, there is a price increase which has happened from first quarter, and also there's 1 or 2 major TPAs where the price has been revised. So this is a normal yearly ritual that we do. So yes, there is some price increase.
How much is that, sir, if possible?
So I think due to it, that typically it's 2.5 to 3%, depending on how much TPA price revision is. You know that TPA price revision doesn't happen every year. It generally happen after 18 months or 24 months, depending on what the contract is. So I think major TPA revisions happened last year. So this will be obviously lower compared to last year. But I think still on the cash side and some of the big TPAs, there will be some price revision. No, I can't give you a value, but I'm saying it's in the lower side of that range that we mentioned.
Okay, great, sir. Thank you for taking my question. All the best, sir.
Thank you.
Thank you. The next question is from the line of Bharat Sheth from Quest Investments. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, you said that our 40% of the occupancy is, our contribution is coming from the lower realization, that is a government kind of a tie-up. And earlier, is that correct understanding?
30%, 31, 34%, which is, it's sure, well, let's say 31%.
Okay. And earlier you had given us some slope that over a time it will come down. So can you give some color over where do we expect in next 3-year time, or how do we see this gradually decreasing every year?
So it was 37%. It's come down to 31%. Okay.
Yeah.
We are over the next 2 years, it will come down to about 15%.
Okay. And that will help us to improve our ARPO, correct?
Absolutely.
Okay. Sir, on this diagnostic, you said that we are also looking for inorganic opportunity. So can you share some color that what kind of a criteria that you have in mind while acquiring geography or specialty kind of what kind of IRR that we expect while taking over any new opportunity?
IRR?
See, on this inorganic opportunity, what kind of internal rate of return that we expect?
So let me put it this way. Okay, we have a ROC of closer to 30%. Okay,
correct.
Across the board. So anything that we do over a period of time has to be accretive. There's no point doing anything which is non-accretive to our ROC. That's one. Secondly, if I look at the laboratory or the pathology business, where the pricing are right now, and my expectation is perhaps in this industry, both margins and multiples will be under stress. Okay, and my mind, it's highly valued. Okay, so if I have to do any acquisitions in this business, I would only use my stock to do it. I will not use cash to do any sort of thing. But again, we have to be able to be convinced about the turn-up opportunities over there.
Qualitative, apart from this financial, qualitative, what kind of, or geographic?
So north is something I would like to do, west is something I would like to do, but not go beyond that. I don't want to go east, I don't want to go, well, I definitely don't want to go south right now. As far as, please understand, out of 5,500 crores, we have, my current business is about 120, 130 crores. And we're talking off a very small base start with.
And do we have some kind of new capability are we evaluating?
New capabilities as well?
So in this specialty type or doing having a contribution higher from the specialty rather than doing a wellness side or normal test?
There are plenty of initiatives on that side, okay, to move up the value chain. We are already focusing on the more high-end stuff, etc., to do, the one-off tests and so on. But again, the path from 100 crores onwards is pretty long to get to a meaningful level.
Okay, thank you.
Is there any big bang initiative we are looking at investing in which will 3x my this thing in the next year or two? No, answer to that is no.
Okay. So, while doing brownfield expansion, what are the capability? Additional manpower on which side we require, how much if you per bed, or if you can share some color.
So typically you have a 5.5 to 6 employees per bed ratio.
Correct.
Right, and brownfield essentially require that. You don't require management. Management is already in place in the subsisting facility, as well as the senior clinicians already in place. So you don't require the high-end for brownfields. Why? First and foremost, the question is, why do you do a brownfield? Okay, you do a brownfield because you run out of space. In our hospital, we run out of space. Okay, in most of our hospitals right now, you can't get beds. The waiting in emergency is anything from 6 hours to 1.5 days. Okay, to get a bed of your choice. Okay. Second, I'm finding it difficult to onboard more doctors. Simply because I don't have operation theaters to give them. I don't have OPD chambers to give them, and I have no patients. I have no beds for the patients. The third is, okay, I've actually had to take up my entire management in the hospital now sitting malls outside the hospitals. Because we've cannibalized those spaces and we've taken up this thing. So therefore, I have a tearing need to do a brownfield. It's like Weak Candy Hospital in Bombay, right? I mean, it's run out of space. They're making a tower. How long will it take to fill that up? And what do you require for it? The doctor is already there. The management is already there. You're making another tower in the same, which is in the contiguous land, right? Therefore, a brownfield.
Okay. Well, thank you very much, sir.
So it's a low hanging fruit.
Okay. Thank you very much, sir. All the best.
Thank you.
Thank you. The next question is from the line of Nikhil Mathur from HDFC Mutual Fund. Please go ahead.
Yeah, sure. Thanks for taking my question again. Can you help me with the gross block number associated with the 3,300 beds that are today operational for the entire group, including the partner facilities?
Yogesh?
I don't get the question. Can you repeat the question, please?
My question is that can you help me with the gross block number for the 3,200 beds which are currently operational, which includes the partner facilities?
Yeah, I think you already have the balance sheet with you.
That has a net assets, I mean, and the typical gross number here.
Yeah, so net tangible asset is 3,227 crores. You would have seen that there. Includes the land and everything else.
Yeah. So plus the accumulated depreciation, what would be the number?
You are saying gross block? Hello?
I'm saying net assets plus accumulated depreciation, the gross asset. What was that number? I can touch offline as well in case it's not handy as of now.
No, so gross block would be in the range of 4,200 crores.
4,200 crores. Okay, that's helpful. And sir, on the institutional business, of the 31% of beds, do you mind sharing what percent of this 31% is towards government beds and what percentage is usually occupied by the NGO or private sort of entities?
Most of this 31% will be the CGHS tariff, entities. So they'll be all state governments or the central government or ECHS type schemes. So it's all CGHS dependent tariff, I would say.
So my question on this would be, if majority of these are government associated relationships, aren't these riders set in stone when the facility would have been built? Wouldn't these have been part of the term agreement of the land or the facility that this specific bed have to be reserved for institutional patients?
No, I think that's different. That is that we have some obligation on the EWS side, which is the economically weaker section. That's a treatment free of cost. We don't get any money for that. And then Abhay alluded to that, the money that is spent around 14-15 crore rupees every month on that treatment. So that's not part of that 31%. Okay, got it. And final question, I think I heard the number 13% of revenues came from digital channels. Please correct me if this number is not right. And the question on this is that are there any significant investments that have been taken in FY22 and FY23-24? Do you envision a lot more spend towards building the digital footprint? Yes, we do. I think we already spent, I would say, I can't give you a number now. We spend a lot of money there. And in fact, going forward, there's an increase in spend on this particular line item. So we have a separate team for digital marketing, right? So there's a outbound town center. There's a bot out there, bot on the website. So there's a lead management team out there. So I think there's a full-fledged department on the digital marketing side. And yes, the budget is going up for them for next year.
So,
I won't like to put the values out there, but it's a significant increase in the budget there.
Okay. So, I'm fine if you are not comfortable sharing the exact number. But is the spend likely to be accelerated in 23, likely to be same in levels with FY22? And is it a long drawn process? 3-4 years of business has to be done, or 1 or 2 years, and then you'll be done whatever level you want to reach at?
I would say this will be a permanent change in the line items in terms of where the sales and marketing money gets spent. And also there will be higher allocation to them for all times to come. As I see it, some of it is also manpower cost, right? So putting more people on it, so you can't do off and on type there. So I would say, if you have to give you a proportion, then probably a 60% increase in the budget.
Sorry, what the proportion?
60% increase in the budget, 60.
Okay. That's helpful, sir. Thank you so much and all the best.
Thank you. The next question is from the line of Bhavya Gandhi from Dalal & Broacha. Please go ahead.
Yeah. Thank you for taking my question.
Sorry to interrupt you, sir. May I request you to come on the handset mode? Your audio is not clear. I believe you're on speaker. Please ask your question on handset mode.
Yeah, can you hear me now?
Yes, thank you. Please go ahead.
So I just wanted to understand, is it so flexible to change the institutional mix to, maybe cash or insurance? Because, we go for institutional mix when our occupancies don't get filled, right? So is it so flexible to switch?
No, you're right. That's why we do it right now. Instead of keeping the bed idle, we do it. But please understand, 2/3 of our business, okay, which is non-institutional, has a particular rate of growth. It's been growing at, let's say, 8-9% per year for the last so many years.
Right.
Okay. Now, as you have seen, we are operating at a 74-75% occupancy level. Maximum we can get to 77-78, which I mentioned, right? So what do I do about the rest? So let's say I have 2,000 odd beds or 2,200 beds will grow by about 8%-9% every year. I need 200 more beds every year. Okay. Now I've got to a stage when I have 60% occupancy, yes, your point holds. But when I'm capacity out right now, what do? I have to displace the business. So it becomes, it's not so much about this thing.
Okay.
Insurance business is growing at a certain rate, right? International is growing at a certain rate, and so is cash. Now, when that segment of business is growing in an environment where we have no capacity, then automatically that distilling will happen.
Right. And another question is with respect to diagnostics. Say, for example, if you are doing a capital deployment out of 100 rupees, the larger chunk is into still the entire hospital spend is into normal hospital business itself, right? So why are for a small pie of 15%, and that right now the margins are attractive, but with competition kicking in, the margins will also start dipping. So why are we looking at maybe acquisition in the diagnostic space? Because from a capital deployment angle, is it viable enough in the longer run? Because our normal hospital business also gives us 25% margin today.
No, it is viable on multiple fronts. You see, please understand, our brand is a lot more than our reach right now as far as diagnostics is concerned. Okay. We get patients from, Max is an aspirational brand, not only for people in Delhi NCR, but also up country and smaller places and so on and so forth. Both for doctors and patients, right? If somebody wants to, get a major surgery, they'll go to Max Hospital. Okay, so imagine now if Max Hospital is providing you pathology in your town, in your small this thing, etc. Right? That's the opportunity. My problem is that my brand is there, my reach is not. And secondly, look, it's not as if, why are people getting into this business? They're getting into it because it's attractive and underpenetrated. Okay. And everything is in its favor. But yes, as right now, it's getting crowded and you're going to have, you have venture capital money coming in, which is discounting and so on and so forth. Right? Very similar to what happened perhaps in the telecom space. But you're going to have a shakeout over here. So you're going to have some of the players, etc., who go out of business. Okay, you'll have some players who are going to be established, etc. Okay, and eventually everybody will raise prices back to, everybody's going to earn some money.
Okay.
The fact of the matter is, do I have more of a right to survive in this business and thrive in this business than others? Okay, my belief is yes. And simply because I have a hospital brand to back it.
Right. So overall, from a margin perspective, will it be more dilutive? Because will we be able to even generate 25% EBITDA margin when it comes to diagnostic? I understand from a brand perspective, it will be helpful.
No. See, please understand. Okay, EBITDA margin means nothing. You have to look at it from ROC standpoint, right? It's a service business. It doesn't require too much this thing. Okay, it's all variable cost. So even from a percentage standpoint, it goes down. It doesn't matter. I mean, I'd rather have a higher ROC.
Okay. Fair enough.
I mean, look at. Sorry.
Yeah.
Go on.
Yeah, go ahead. Yeah.
I think that's the reason. Is precisely the reason that you mentioned. We moved out of suburban. We were trying to do the inorganic transition with suburban, but beyond a point we didn't go further, and obviously Lal spent more money than we thought we will be spending on it. So yes, we are very, very cognizant of the fact that this should be ROCE accretive.
Right. And from an expense standpoint, normal expenses, we talk about expenses, is there any room for any of the expenses where we can control and maybe do some sort of margin? Because our employee cost cannot be adjusted, right? Doctor consultation fees, because that is the key in the entire business. So whatever adjustments we were about to do, we've done. One, by changing the clinical mix almost at optimum level, right? And you were trying to change the payer mix. But from an other expenses standpoint, is there any room wherein we can sort of adjust our expenses and there's a lever to maybe increase our margin?
So 3 years ago our margin was 8.8%, and we gave a plan. Okay, and the total EBITDA of the company, okay,
right,
was 340 crores, and we gave a plan for 220 crores in the first year, another 120 crores in the second year. That's 340 crores is equivalent to the entire EBITDA of the company. And we actually implemented it, right?
Right.
Okay.
No, that's commendable. There's no denial on that.
So the point I'm making is, all of the stuff we were talking about on the expense side, etc., we've done it, right? I mean, by the end of the day, anything further, you have to sort of maintain a balance. You don't want to compromise on outcomes or the patient services. Our Max being a metro brand, in Delhi and Bombay and stuff like that, our patients generally tend to ask for more. So we have to ask for more of ourselves as well. The whole feature comfort, etc., is a lot more than that. So I don't see any. It's incremental this thing. In our understanding, there is, and there are two things that we sort of pride ourselves about. Okay, is very tight cost management, and the second is very disciplined as far as capital allocation is concerned. So these have been our two main sort of stays as operators.
Right. Fair enough, sir. Thank you so much.
Thank you.
Thank you. We'll take one last question, which is from the line of Nisar Parekh from Nature's Capital. Please go ahead.
Yeah, hi. Thank you. My question is, how do you look at, you kind of alluded to briefly, but how do you look at your geographic expansion? With few new acquisitions also made in Delhi, so at what point do you think that you've reached an optimum capacity in Delhi NCR and you would like to make this a bit more geographically diverse spread by maybe entering a bit more into west or south?
Look, I think first and foremost, you obviously always look at the low-hanging fruit in your backyard before you go further and so on. And we've done that, and we will look at other geographies. We are looking at other geographies. It's not as if we are not there in Uttarakhand. Our highest ROC business is over there. It's not as if we are not in Mohali. We have a fantastic business over there, which again. So my highest ROCs are, in fact, not Delhi and Bombay. They are the other towns, and we will see our focus over there. But you also understand, our focus over there will be perhaps through M&A and not through build-outs.
So I'm just trying to understand 3, 4, 5 years out, Delhi say 70-75%, Delhi NCR. Where do we see that mix going, and do we see mix of like you said, maybe non-metro tier 1 towns actually increasing? So how do you see that mix for the next 3 to 5 years?
It's tough to sort of answer that question, right? I mean, if let's say I get a opportunity to buy Medanta tomorrow, okay, it's already making money. For example, if I do a transaction like that, I'll have 1,200 more beds in Delhi. You're going to ask me then, look, you have further concentration. The problem is it's not concentration. You have to play it on merit. It's an existing business which is already, I perhaps won't do a greenfield in Delhi. But if I get an opportunity to buy something which I believe I can turn up even further, okay, why wouldn't I do it? So, although we are proactive, we are also reactive. In M&A, you have to be reactive as well, right? So it's a little hard to sort of define, look, what our geographies will be. If I get a very good opportunity, if I get good opportunities in Bangalore, I'll go to Bangalore tomorrow. I must get it.
Got it. And my second question is on medical inflation, right? What are you seeing on medical inflation? Are you seeing that picking up, more than average given things around? And do you see any kind of regulatory risk on price caps, etc.? Government has been coming out with slew of regulations to kind of curb inflation. So what is your sense on regulatory impact on the healthcare sector to kind of curb any medical inflation which might be in excess?
It has to be inputs, right? By the end of the day, if there is inflation on input costs of medicine, consumers, etc., for us it's a pass-through. We essentially pass it on to the patient because if any inflation increase in MRP, that's just passed on to. And we are basically only making a margin out of that.
But you don't see any kind
overall,
of like.
No, I don't. There's never been an output price cap. There's always been a price cap on inputs.
Right.
Okay. And we had that conversation. I've already provided my views on why the stent and the implants, etc., and probably it was a welcome thing. But overall, you have to understand one thing. If there's one sector, okay, which is counter-cyclical, is anti-inflation, is insulated from inflation, is perhaps the medical sector, right? I mean, not India, globally, not only us. I think that's the nature of this business. It's a defensive. In India, it's offensive simply because of the huge under-penetration.
Got it. Thank you. And just one data point question, if you can. Given Q4 has been impacted by Omicron, can you provide March 22 month RPOB and occupancy?
No, we won't be able to share you that data now.
Okay, sure. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today.
But I think coming to the last one, but look, keep in mind one thing, what is being disclosed. Hello?
Yeah, we're there.
Yeah, so I think the occupancy in January was 60. The average occupancy for the quarter was 68. Okay, so I'm sure you guys can work out perhaps or closer to where you were in March.
Yeah, got it. Thank you, sir.
Yeah, okay, thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments.
So thank you everybody, for joining late in the day today. But we tried not to make it a habit, and next time we'll make it a more convenient time for everyone. Thank you so much.
Thank you.
Thank you, everybody.
Thank you. On behalf of Max Healthcare, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.